You see it everywhere now, digital gold. It's sold to us as this super simple, modern way to own a classic, timeless asset. But, behind that shiny app interface, there are some pretty serious hidden risks. So today, we're going to peel back the curtain and find out what you're really buying when you tap that button. I mean, this is the pitch, isn't it? It's the promise that has pulled in millions of people. The idea that you can own an asset like gold, something that's been valuable for thousands of years, with just a couple of taps on your phone. Well, it's incredibly appealing. It feels easy, it feels instant, and you think it feels safe. And wow, is this pitch working? In a country like India, which has this deep, deep love for gold, the digital version has just exploded. By August of this year alone, UPI transactions for digital gold hit nearly 1,180 crore rupees. That is a staggering amount of money flowing into this brand new, and as we're about to see, mostly unregulated world. So what's the hook, right? Why are millions of investors, a lot of them brand new to the markets, flocking to digital gold? Let's take a closer look at what makes it so attractive. Well, the product is just perfectly designed for how we live today. You can buy pure 24-karat gold in an instant without even getting off your couch. You don't need a ton of money either. You can get started with just 100 rupees. And the companies tell you it's all safely tucked away in a secure vault, in your name. It basically gets rid of all the old school hassles of buying physical gold, storing it, and getting it insured. But you know how the saying goes, not all that glitters is gold. This huge surge in popularity hasn't gone unnoticed. And India's market regulator, SEBI, has started waving some pretty big red flags. And this right here is the absolute heart of the issue. In a recent caution note, SEBI made it crystal clear that the digital gold being sold on so many of these popular apps is fundamentally an unregulated product. That means there's no official watchdog making sure these companies are playing fair with you, the customer. And it's not like India doesn't have official, safe ways to invest in gold. We do. There are several options, from gold ETFs to electronic gold receipts. The crucial difference is that all of these operate under SEBI's rulebook, which gives you a layer of protection as an investor that most of these digital gold apps just don't have. So what's the real practical difference then? When you hit that buy button on a digital gold app, what do you actually own? Is it the same as buying a share of a company or a gold ETF? Let's break it down. Okay, so this is how the regulated system is supposed to work. When you buy a stock or an ETF, your assets are held in your DMAT account with government-backed depositories. The best way to think about these depositories is like a super secure, independent locker just for your financial assets. This means they are legally separate from the company that sold them to you. So if your broker were to go out of business tomorrow, your investments would still be completely safe. And here's where you see the difference, and it's like night and day. On one side, you've got the regulated world, a full SEBI framework, government-backed depositories, independent audits, the whole thing. Your assets are legally separate from the company. On the other side, with digital gold, your so-called ownership is really just a private contract with the app. If that company fails, there's no safety net. You're on your own. This lack of a legal safety net introduces a massive risk. And it's got a name, counterparty risk. It sounds complicated, but it's simple. It just means you are betting all of your money purely on the trust you have in that one single app or company. If they go under, you're just another person in line trying to get your money back from a failed business. There's no guarantee. But it's not just these big structural risks you have to worry about. There are also immediate costs, often hidden costs, that hit your investment from the very first second you make it. So, let's follow the money, shall we? You decide to invest 10,000 rupees, but you don't actually get 10,000 rupees worth of gold. Nope. Right off the bat, 3% is taken away as GST because it's treated like you're buying a physical good. Then the platform itself takes its own cut. They call it a spread, which is another 2 to 3%. That's their profit. So let's just be crystal clear about this. The moment you invest, your investment is already down by up to 6%. Your 10,000 rupees only gets you about 9,400 rupees worth of actual gold. The price of gold would have to go up by more than 6% just for you to break even, let alone make any profit. Okay, so now that we've seen the risks and the hidden costs, let's talk about the safer path. If you want to invest in gold digitally, what are the regulated and, more transparent alternatives? Just look at this, side by side. It makes it so clear. Gold ETFs are regulated by SEBI. Digital gold is not. The price of an ETF is public and transparent on an exchange. With digital gold, the price is whatever the company decides it is.
And most importantly, you have very low counterparty risk, and you don't get hit with that initial 3% GST. It's just a fundamentally more secure way to invest.
So, just to sum up the better alternative, gold ETFs give you that same digital convenience, but they come with layers and layers of regulatory protection. The pricing is transparent, they're super easy to buy and sell, and most critically, your holdings are kept safe and totally separate from the broker you use to buy them. So, the next time you're scrolling and you see that shiny Buy Digital Gold button, maybe just pause for a second. It brings us to this final question. When an investment is sold to you as being this simple and effortless, what hidden risks and hidden costs are you accepting without even realizing it?